So far, we have seen cases where every corporate deal done is hedged in the market by the dealer taking an equivalent position in spot, plus swapping the cash flows by paying or receiving a premium or discount. However, in reality, the dealer would not be constantly covering his position back to back. Rather than swapping cash flows from spot to 3 months or other tenors, a dealer might roll over his positions short-term or even on a daily basis. However, one-day rollovers can be quite expensive if you are a payer of a swap, since overnight rates are sometimes higher than long-term rates, especially when the yield curve is inverted, and much more volatile. If you are a receiver of a swap, you might not receive the same number of points as you would have if you were receiving long forwards because of the daily spreads you would need to pay. So example is, if the dealer were to roll over his or her long position daily, she would need to sell by 1 million USDJPY at roughly 0.3 pips. Besides the bid-ask spreads, keep in mind the transaction costs that are incurred due to clearing and settlement, credit risk spreads, plus other costs, making rolling over positions much more expensive. Now, in reality, dealers are provided with a daily foreign exchange gap position sheet to manage their cash flows in multiple currencies by the back office. And the gap position sheet would look essentially like this. There would be a daily position sheet. So as of 13/06, the sheet would look like this. You would perform swaps throughout the day, and by the end of the day, the back office would take into account all the swaps, all the cash flows that were modified today due to the swaps, and prepare a new gap position sheet for the next day. We can see that the dealer has mismatches in cash flows across multiple tenors and multiple currencies due to interbank and customer positions. It is therefore important to note that the dealer might not cover customer positions back to back for every single position. So we've seen so far that for every position, we've said that the dealer would go and buy. If the customer is buying $yen, the dealer would go and buy $yen in the market. If the customer needs to do a sell-buy swap to push the buy position for 3 months forward, that the foreign exchange trader would do the same in the market and pass on the rates to the customer. But however, in reality, because the dealer already has gaps in his cash flows, he might simply warehouse these customer positions and try to manage his cash flows better, saving transaction costs and the bid-ask spreads on spot plus swaps. So it is therefore important to note that the dealer might not cover customer positions back to back for every single position. The dealer might absorb customer positions by warehousing the positions. So let us assume now that the dealer has a long $yen position of 10 million, which is in the money. If the customer calls wishing to buy 5 million USDJPY value cash, the dealer would quote the customer a price for a spot and then quote a buy-sell swap for value cash over term or cash over spot. However, since in this case the dealer is already long in his positions, he could simply square off half his position and then use the existing dollars in the Nostro account to pay the corporate $yen cash, saving transaction costs and the bid-ask spread by not covering the position in the market. So let's now take stock of where we are. As we have seen, an outright forward is simply a combined price of the spot rate plus an FX swap. For example, when the corporate dealer in the US wishes to hedge a sterling 10 million import due 1 month from today, he or she calls the dealer to ask for an outright price. the dealer would construct the price by using the market rates and passing these market rates onto the corporate dealer. Now, assuming you are the dealer, since it's really important by now that you should have a clear understanding of how to price these contracts, assume that you are the dealer and pause the video and construct the final rate for the sterling importer after getting all the rates, the spot rate, the forward rates, and assume a customer margin of 2 pips. So since the corporate wishes to hedge a sterling import, the corporate needs to buy sterling 10 million 1 month forward from today. The dealer checks the sterling ask rate, adds the cash over 1 month swap rate. Since the cash spot rate isn't readily available in the figure, we can simply add the cash term rate and the term next rate to give us the cash spot rate. Now add the spot over 1 month rate to that rate plus the margin. So therefore, in order to cover the customer exposure, the dealer would need to buy sterling 10 million spot, sell by sterling 10 million spot, and assuming that the rates are as below, sterling is 50.52, the overnight is 0.8893, term next is 0.28.32, 1 month is 13.14 and 13.34, and the customer margin is 2 pips. Since the sterling is a premium to the dollar, the dealer needs to do a sell-buy swap. He or she would be a payer of the swap and therefore pay a total of 0.93 plus 0.32 plus 13.34 1 month swap, which is equal to 14.59, roughly 15 pips. So therefore the rate that the corporate would get would be 1.2952 plus 0.0015 plus 0.0002, which is equal to 1.2969. This is the rate that you would quote to the importer in order for the importer to hedge his imports. So hopefully you've got this to a complete understanding, because going forward we now try and understand how these FX swaps are priced. How do we get this 13.34? And we will see that these forward prices or these FX swap rates are nothing but derivatives of interest rates, and we will use the no arbitrage model to simply derive these rates. It's a very simple method that's used to price most derivatives, and we will use the same method to price the FX swap rates. So let's look at that next.